Social Security is the backbone of most Americans' retirement, and you are guaranteed to get several questions about it on the CFP exam. In this video, we're going to walk through the foundational concepts of Social Security. I'm going to give you a dead simple breakdown of exactly how Social Security works. We'll focus on the core framework, who's eligible, how benefits are calculated, the impact of timing, and how benefits are taxed. Once you understand this foundation, everything else falls into place. You'll have the confidence to tackle any Social Security question on the CFP exam, and you'll be able to help your clients make decisions that could be worth hundreds of thousands of dollars over their lifetime. Let's get started. Social Security was created in 1935 during the Great Depression, when it became painfully clear that most Americans had no reliable way to support themselves in old age. Prior to Social Security, about half of all seniors lived in poverty. Today, for most retired people, especially those that are single, Social Security makes up 50% or more of their income. Now, the genius of Social Security's design is not that it's just a retirement savings account. It's insurance. It's insurance against the three major risks that can derail your financial security: living beyond your ability to work, becoming disabled and unable to work, and dying and leaving dependents behind. That's why Social Security is also referred to as OBBBA. Old age, the retirement benefits we typically think about when we hear about Social Security. Survivors, benefits for your spouse, children, other dependents if you die. And disability, benefits if you become unable to work. Now, the Congressional Act which created Social Security, it also created Medicare and supplemental security income, topics for another video. Social Security works through a payroll tax called FICA, Federal Insurance Contributions Act. Both you and your employer pay FICA taxes to cover Social Security and Medicare benefits. Now, if you're self-employed, you act as both the employer and the employee. Now, the portion of FICA related to Social Security, that is capped. For 2025, the max income subject to the Social Security portion of FICA is limited to $176,100. Now, there's no need to memorize that, by the way. It is on page 5 of the exam tax tables. Now, any income you earn above that Social Security wage base is not subject to the Social Security portion of FICA. Now, almost every working American is eligible to participate in Social Security and is subject to FICA. This includes non-citizens, such as people working on green cards. There are, however, 3 notable exceptions. First are children under the age of 18 working for their parents in an unincorporated business. This is a common exam trap. If Johnny works for his dad's sole prop, he doesn't pay FICA. Second, certain religious workers. Ministers, members of religious orders, and Christian Science practitioners can claim an exemption if they choose to. Additionally, Native American Tribal Council members may also opt out of Social Security. And third, railroad employees. Social Security was created during the Great Depression when railroads were a big deal. They have their own separate system called railroad retirement. Now, in order to be eligible for all Social Security benefits, you need 40 credits or 10 years of work to be fully insured. You earn credits for every $1,810 in earnings you make. Now, this number adjusts every year, and it's not an important figure to memorize. Each year, you can earn up to 4 credits. Now, you can sometimes hear credits referred to as quarters, which suggests some kind of timing element, but that is no longer the case. As long as you make 4 times $1,810, or about $7,200 during the year, you get 4 credits. It doesn't matter if you make that money in 1 month or across all 12. Once you've accumulated 40 credits in your lifetime, you become fully insured and can never lose OBBBA benefits, even if you stop working. Now, as an aside, there is another concept called currently insured. That's when you have at least 6 credits from the last 13 quarters. This primarily grants survivor benefits to children and their caretakers in case you die before you become fully insured. Plus, there's a lump sum death benefit. So now that we understand what Social Security covers and who's eligible, let's talk about the benefits themselves. But before we get there, do me a favor and hit the like button. A 30-minute video about Social Security stands no chance of going viral. So if you're finding this video helpful, please share it with someone else you know who's studying for CFP certification. I appreciate it. All right, moving on to benefit amounts. Your Social Security payout is a function of how much you've earned. Social Security takes your highest 35 years of earnings, adjusts them for inflation to get your average indexed monthly earnings. Then they apply a progressive benefit, so it's not linear, it actually tapers down the more money you make, to calculate your primary insurance amount, your PIA. Your PIA is your golden number. That is what you receive if you claim benefits at your full retirement age. Everything else, early retirement, delayed retirement, spousal benefits, survivor benefits, they are all calculated as a percent of your PIA. What are those percentages? Well, let's start with the OA and OASD old age benefits. These are the retirement benefits most people think about when they hear Social Security. If you start claiming Social Security at your full retirement age, you get 100% of your PIA. If you claim before your retirement age, your benefits are permanently reduced. And if you delay claiming until after full retirement age, you earn additional delayed retirement credits. What's early, what's on time, and what is late? Well, for Social Security, there are 3 magic ages you need to remember. The first is 62, the earliest you can claim benefits. The second is full retirement age, which is 66 to 67, depending on your birth year. And the last is 70 years old, the latest you can delay retirement benefits and receive extra credit. Old age benefits are not just limited to the covered worker. Remember, Social Security was created during the Depression, at a time when many women did not participate in the formal economy. The original act was limited to just the individual worker, but a few years later it was expanded to include spouses and dependents, making it a family-based Social Security system. The base amount for spousal benefits is the higher of your own benefit, if you yourself are fully insured, or 50% of your spouse's PIA. Now, notice that I said PIA. The spousal benefit is based on your spouse's full retirement age benefit, even if they end up claiming early and taking a reduction. Similar to the covered worker, spousal benefits can be claimed as early as 62 with penalties, or at full retirement age of 66, 67. There is no delaying the 50% spousal benefit. Though if you were fully insured as a result of your own employment, that of course can be delayed for credit. Now, spousal benefits extend to ex-spouses as well. Divorce spousal benefits work exactly the same as normal spousal benefits, but with 3 important requirements. The first is that you must have been married for at least 10 years. This deters any, hey, let's get married for Social Security schemes. You cannot be remarried, so if you remarry, your benefits are based on your new spouse. And lastly, after being divorced for 2 years, you can claim independently, even if your ex-spouse hasn't filed for benefits themselves. This is different from the married spouse who has to wait until the covered spouse files for retirement benefits first. So that is old age or retirement benefits. Now let's shift gears and talk about the S in OASD, survivor benefits. These are triggered when a covered worker dies. Now, the surviving spouse doesn't simply get to continue receiving the deceased's benefits. That is, if your spouse was receiving $2,000 a month and you were receiving $1,000 for spousal benefits, you don't get to keep collecting $3,000 per month. Instead, surviving spouses get the greater of their benefit, whether that's based on their own work history or the 50% spousal benefit, or 100% of the deceased's benefit. In other words, you get the higher of your or your spouse's benefit, but not the combined total. To start receiving survivor benefits, the surviving spouse must be age 60 or older. So I lied, this was the 4th age you need to remember. Or they can be any age if they're caring for this deceased worker's child who's under 16 or a child who's disabled before 22. Divorced surviving spouses have the same benefits and rights as current spouses. The 10-year marriage rule still applies, but the remarriage restrictions are a bit different. Now, the children of the deceased are also eligible for their own benefits if they are under the age of 18 or under the age of 19 and full-time students in high school. Note that college does not count here, or any age if they were disabled. Now, survivor benefits is also the one area where dependent parents can claim benefits. Again, not all parents are eligible, they must be dependents. Okay, so let's take all of those survivor benefit rules and look at an example. I was looking through a list of celebrities that had passed away recently, and one jumped out, George Foreman. Now, you might know him for his boxing career or maybe for his grills, but did you know that Foreman was married multiple times and had 12 children? Let's take a look. According to Wikipedia, the Olympic gold medalist and heavyweight champ was married 5 times. Are any of his ex-wives eligible for survivor benefits? No. since none of those marriages lasted for 10 years. Okay, but maybe they're eligible through their children. Now, several of them did have children with Foreman, but none of those children are under the age of 16 and none are disabled. So, no again. How about his widower, Mary? Is she eligible for survivor benefits? They were married for 40 years and were married when Foreman died. A quick Google search suggests that she's 62 years old, so she is eligible to claim benefits based on her relationship and her age. Finally, let's talk about the kids themselves. Well, first off, I need to mention that 5 of them were named George Foreman. Yep, he named all of his sons after himself. Plus, he had 7 daughters. Now, as we mentioned before, all of them are adults now and none are disabled, so none of them are eligible to claim survivor benefits. Now, this is obviously an extreme example, but let's use it to imagine a different but parallel family. This time, the children were much younger when the patriarch died. Now, who's eligible for survivor benefits? Take a second and pause the video. Ready? Let's start with the ex-wives. There is one ex-wife number 3, who is married for at least 10 years. We don't have her age here, but given the children's age, it's pretty safe to say she's not 60 years old, so she's not eligible that way. Okay, but are any of the ex-wives eligible based on the fact that they're taking care of young children? Yes, we've got several kids under the age of 16, making themselves and their mothers eligible for survivor benefits. In addition, we've got several children under the age of 18, so these children are eligible, but their mothers are not. And we also have one 18-year-old. They are not, as the rule requires, under the age of 18, and since we have no indication if they're in high school or not, we're going to assume they're not, and therefore they are not eligible for survivor benefits. So in our make-believe example, here are all the folks eligible for survivor benefits based on this single deceased fully insured worker. Now, Social Security does have this idea of a maximum family benefit. It's not something you're going to need to calculate on the exam, but it's something worth being aware of depending on your practice area. When you look at your Social Security report, you'll see the maximum family benefit listed. It's generally about 150 to 180% of your PIA. In the case of our imaginary family, it is likely that everyone's benefits will decrease significantly to make up for the fact that there are so many people claiming. Finally, I want to mention that there is a one-time $255 death benefit. This is meant to help cover funeral costs and other costs, though clearly it has not kept up with real-world numbers. It's made either to the surviving spouse or an eligible child. It's a one payment per family benefit. Okay, now let's finally talk about the last Social Security benefit, the D&OASD disability. This is available if you are under 65 and meet Social Security's strict definition of disability. In order to be considered disabled for Social Security purposes, you must be unable to work for at least 12 months or have a condition expected to result in death. This definition is much, much stricter than most private disability insurance. It also gets a little more complicated because Social Security benefits have a 5-month waiting period. This is crucial to understand. So your benefits don't start until the 6th month of disability. In practice, it works like this. So if you become paralyzed in an accident, Social Security knows that you'll be disabled for more than 12 months, so your benefits start in month 6. But if they're unsure about your condition, you may have to wait the full 12 months to prove you're disabled, and then you get back pay for month 6 onwards. Your spouse and your children can also receive benefits on your disability record using the same eligibility criteria as retirement benefits. All right, so that was a lot of eligibility criteria. If you are still unsure how to track all these, I created a worksheet that you can download for free. There is a blank version so you can take notes while watching this video, or better yet, after you've finished watching this, pull out the blank worksheet and do a brain dump. Don't look at any notes, just see how much you can remember. Then scroll down because I've got everything filled in. Compare what you have with the answer key and see what you're missing or might have gotten wrong. The first time you do it, you might only get a third or a half right. That's perfectly normal. Do it again tomorrow and then again a few days later, and you will be surprised at how much you'll have learned all of these rules. So earlier, we talked about how when you claim retirement benefits, impacts the amount you received. While you can start claiming old age benefits as early as 62, the government really incentivizes you to wait for your full retirement age. They do this by permanently reducing your benefits. Remember, at full retirement age, you get 100% of your PIA. Claim early, and your benefits are reduced by 0.5% for each month, up to 36 months or a 20% reduction. Retire more than 36 months before, and the penalty stacks, albeit less steeply, at 0.5% for each additional months for an additional 10% reduction. So if you retire 5 years earlier than your FRA, your benefits are reduced by 30%. Let's work through an example. Beth, age 65, decides to claim Social Security 24 months earlier than her FRA. How much are her benefits reduced? Well, we're going to multiply 5/9 with 24 months. We get 13.33. Now, technically, you would multiply that again by 1%, but really, you know the answer. Now, some people like to do this calculation by taking the months early and dividing by 180. I actually prefer to remember 20 divided by 36 instead of 5/9 for the 20% maximum penalty at 36 months. They all give you the same answer. And since we're using calculators, it kind of doesn't matter which fraction you choose. Pick one, slap it on a flashcard. Now, what is super important to remember is that this reduction is permanent. So even after Beth reaches her full retirement age, she's still only receiving 86.67%, or 1 minus the 1, 13.33 of her PIA. And when she dies, that penalty continues to impact her survivors. That's why it's so important for clients who need to claim Social Security early, that they claim it early on the spouse with the lower benefit, if that's possible. Now, another thing you need to worry about when claiming Social Security early, it's the earnings test. If you collect early and you continue to earn income, that can temporarily decrease your benefits. Yeah, Social Security really doesn't want you claiming early. Now, if you earn over a certain limit, this will reduce your monthly benefits. These earning limits are on the exam tax tables, page 5. It works like this. If you are younger than FRA for the entirety of that year, Social Security deducts $1 from your benefits for every 2 that you earn above, and in the case of 2025, $23,400. In the year that you reach FRA, Social Security deducts $1 for every 3 that you earn above a second income level, which is $62,160 for 2025. And this does not apply for the month that you reach FRA, aka your birthday month. Now, unlike claiming early, this is not a permanent loss. When you reach FRA, Social Security recalculates your benefits to account for any benefits withheld due to your earnings. And in other words, you still get the money, it's not lost, you just get it after FRA. Now, let's imagine that Beth, from our previous example, she continues to work part-time. So she makes $28,400. That's $5,000 above the earning limit. Beth's Social Security benefit is going to get reduced for $1 for every 2, or $2,500 that year. Note, only Beth's earnings count towards this earnings test. If she's married, her spouse's earnings does not affect her benefit, though it may affect the taxation of her benefits, which is something we're going to talk about in a few minutes. Now, as much as the government discourages you from claiming Social Security benefits early, they also incentivize you for delaying claiming. For every year you delay past your FRA until age 70, you earn delayed retirement credits worth 8% per year. This is calculated monthly, and it is big. If your FRA is 67 and you wait till 70, you get 3 years times 8% per year, or a 24% increase. So instead of 100% of your PIA, you receive 124%. In absolute dollars, this is huge. If your PIA is $2,000, claiming at 67 gives you $2,000 per month. Wait until 70 and you get $2,480 per month. That's $480 more per month for the rest of your life. If you live another 20 years, that's an extra $115,000 over your lifetime. Plus, delayed retirement credits, just like early claim penalties, are included when calculating surviving spouse benefits, but not for other family members. Okay, before we wrap up this video, let us talk about one last thing: taxes. Social Security benefits can be subject to federal income tax. This is based on your provisional income, or your MAGI, plus half of your Social Security benefits. There are 2 thresholds to be aware of. Below the first threshold, Social Security benefits are not taxable. Between the first and the second, up to 50% are taxable. And above the second threshold, up to 85% of benefits are taxable. Now, let's be super duper clear here. Up to 85% taxable does not mean you are paying an 85% tax on your Social Security. It means that 85% of your Social Security is included in your taxable income that is taxed at your marginal income tax bracket. Well, let's go back to our example of Beth. Beth decided to claim Social Security old age benefits early while continuing to work. Let's say when all is said and done, her benefits are now $10,500 annually. She's also making $28,400 from her part-time job. Now let's assume she has no additional income to consider. Her provisional income is $28,400 plus half of $10,500 or $33,650. If Beth is single, this puts her above the first threshold but below the second. So in this case, she would need to include up to half of her Social Security benefits when calculating her federal income tax. Now let's say that Beth has a spouse who is also earning income. What is the max income they can make before bumping Beth into the 85% benefits threshold? Well, in this case, Beth is now married filed jointly. The 85% threshold is $44,000. $44,000 minus Beth's provisional income of $33,650 means her spouse can make only $10,350 before bumping her into the next tax threshold. Now, these thresholds, by the way, they have not changed since the 80s and 90s. They are not indexed to inflation, which means more and more retirees are paying taxes on their Social Security benefits. These thresholds are also not included in the exam tax tables, so throw them in a flashcard. Honestly, given all that you need to remember for the exam, I would just pick one set of thresholds, say the married filed jointly ones, and just memorize those. If your exam has a singles question, do some quick and dirty calculations by decreasing the thresholds by 7,000. That'll get you in the ballpark of the answer. But more than likely, if you do see a question about this on the exam, it will be conceptual rather than computational. Now, for the real world, the insight here is that as your other retirement income increases, say from RMDs, ordinary dividends, or a working spouse, you are very likely to get taxed on your Social Security benefits. But if you rely almost exclusively on Social Security benefits, then you're likely not going to get taxed. Now, a quick note, this is an area in flux. The 2025 Budget Reconciliation Bill, aka the OBBBA, introduced a temporary non-refundable deduction for individuals 65 and older. It does not affect the income hurdles we just talked about. Instead, it's a $6,000 deduction, or double for married filed jointly, that stacks on top of their normal deduction. So effectively, fewer people will pay taxes on Social Security income. All right, my friends, that is the foundational concepts you need to know about Social Security for the CFP exam. We'll talk about Social Security integration with employer-sponsored qualified plans in another video. If you're watching this in September 2025, you are in luck because I will be releasing more videos on retirement planning every few days. I'll link the full retirement planning playlist here. Happy studying, and I will see you in the next one.